Every single price bar tells a story of who is trapped and who is making money, but only if you know how to read the tails. Most traders look at a chart and see random movement or rigid patterns. But a professional price action trader sees a constant negotiation between buyers and sellers. To understand the market, you must first master the atomic unit of the chart, the price bar. We are stripping away the indicators. No moving averages, no RSI, no MACD. We are focusing purely on what price is telling us right now. This is the foundation of the Al Brooks methodology. A price bar represents a specific duration of time, whether it's 1 minute, 5 minutes, or a day. Regardless of the time frame, the psychology remains the same. It is a record of human emotion and institutional logic condensed into 4 key data points. These 4 points are the open, high, low, and close. The relationship between these 4 prices determines who owns the market at that moment. Let's break down the anatomy of a single candle. The open is where the auction begins. It is the starting balance. The high and low represent the extremes of sentiment, the maximum panic or maximum greed during that period. But the close is the most important price of all. The close tells us who won the battle. If the close is higher than the open, bulls are in control, creating a bull bar. If the close is lower than the open, bears won, creating a bear bar. The distance between the open and close is the body. A large body indicates strong conviction. It means the market moved in one direction and stayed there. However, the lines extending above and below the body are the tails, or wicks. In price action trading, tails represent failure. Think about what an upper tail really means. During the life of the bar, buyers pushed the price up to the high. But by the time the bar closed, sellers had forced the price back down. The bulls tried to own that higher price and failed. Conversely, a tail at the bottom shows that bears tried to push the price down, but buyers stepped in and rejected that lower price. Understanding tails is critical because they often reveal where traders are trapped. Let's look at trend bars versus trading range bars. A trend bar has a large body and small tails. It indicates urgency. Institutions are buying or selling aggressively and are willing to pay up to get into the market. When you see consecutive trend bars, the market is in a breakout mode. This is not the time to fade the move. The market is telling you that one side is overwhelmingly stronger. We simply want to follow the strength. On the other hand, we have trading range bars, often called dojis. These have small bodies and prominent tails. The open and close are near each other. This represents indecision, balance, or a pause in the action. Dojis tell us that neither buyers nor sellers are in control. The market is searching for value. In a strong trend, a doji is often just a pause, but in a sideways market, it signifies that the chop will continue. Now let's discuss signal bars. A signal bar is a setup bar that alerts you to a potential trade. The best signal bars are trend bars in the direction of your trade, with very small tails. If you are looking to buy, you want to see a bull reversal bar. This bar should have a tail at the bottom, rejecting lows, and a close near its high. This shows the bears failed and the bulls took over. If the signal bar has a large tail on top or a weak close, it is a low probability setup. Context is king. Even a perfect-looking bar can fail if it forms in the middle of a tight trading range. Following the signal bar is the entry bar. This is the bar where you actually click the button. We usually enter on a stop order just above the high of the signal bar for a buy or below the low for a sell. The entry bar acts as confirmation. If the market triggers your entry but immediately reverses, the setup has failed. We want the entry bar to be a strong trend bar in our direction, proving our thesis was correct. Let's analyze bar size. The size of the bar relative to recent bars measures volatility. If bars suddenly get huge, volatility is increasing. This can mean a breakout, but it can also mean a climatic exhaustion. A massive trend bar at the end of a long trend often signals the end of the move. This is a buy climax or sell climax. The last buyers have panicked in, and there is no one left to push price higher. Conversely, tiny bars indicate a lack of interest or the calm before a storm. When bars contract and overlap significantly, we are in barbed wire. This is a dangerous place to trade. We wait for a breakout. Reading overlap is crucial. In a strong trend, bars have very little overlap. The low of the current bar is often higher than the high of the prior bar. This gap shows extreme strength. When bars overlap significantly, say 50% or more, the market is two-sided. Bulls and bears are both active at the same price levels. This destroys trend momentum and creates trading ranges. Let's practice reading a sequence. Here, we see a bear trend bar, followed by a pause bar, and then another bear trend bar. The pause bar had a weak bull body and tails on both sides. This pause was a failed attempt by bulls to reverse the trend. The subsequent bear bar confirms that the sellers are still in control. This is a low one setup in a bear trend, a continuation pattern. Always ask yourself, who is trapped? If you see a bull bar that traps buyers, followed immediately by a bear bar that closes below the bull bar's low, those buyers are now losing money. They will likely sell to exit their position, adding fuel to the downward move. Price action trading is largely about exploiting the pain of trapped traders. We enter where they are forced to exit. Mastering the individual bar is the first step. Next, we will learn how these bars form market structures like channels and wedges. But remember, if you can't read the story of one bar, you can't read the book of the market. Master the single bar to master the entire chart.